Cryptocurrencies are here to stay, and more people are getting involved every day. As the industry grows and becomes more mainstream, it's important to stay on top of your tax responsibilities. Don't worry, it's not as intimidating as it sounds. We'll show you everything you need to know about reporting your crypto taxes in this fun and informative video. From why it's important to how to minimize your tax burden, we've got you covered. Let's make sure we're all following the rules and getting the most out of our crypto adventures. Hey everyone, thank you so much for stopping by and seeing us here at Crypto Bookworm. If you're into all things cryptocurrency and NFTs, or trying to get into those things, you have come to the right place. Our goal is to keep you up to date on the latest and greatest in the world of digital currency and assets. And you can take it from us, it is a wild ride. So buckle up and join us as we dive into the exciting world of crypto and NFTs. We're going to have some fun and we're going to stay ahead of the game together. So sit back, relax, and let's dive into the world of crypto taxes. Before we begin, I must stress that nothing in this video or any of our content is financial advice. If in doubt about anything regarding your taxes, please seek the help of a tax professional. With that out of the way, let's start by examining why cryptocurrency is taxed even though it is decentralized. The Internal Revenue Service, the IRS, claims that the majority of cryptocurrencies are convertible virtual currencies. This means that they serve as a medium of trade, a store of value, a unit of account, as well as a stand-in for actual money. It also implies that any earnings or income you get from your cryptocurrencies are subject to taxation. Therefore, knowing whether or not you have to pay taxes if you use or own cryptocurrency will help you avoid being caught off guard when the IRS comes to collect. And you know they will. But this fact does remain: you don't pay tax simply for owning crypto. You can check out our previous video on how cryptocurrency is taxed to get a better understanding of when you will have to pay taxes on crypto. Now that that's out of the way, let's get right into it. The first step to reporting cryptocurrency on your taxes after knowing the actions that trigger them is to calculate your capital loss or gain in your holding. The name says it all. Capital losses are incurred when you sell your token for less than its original purchase price, and capital gains refer to the profit you make for selling your coins at a price higher than the purchase price. This then brings us to an important term you have to take note of when dealing with crypto taxes. We are talking about none other than the cost basis of your holdings, which describes the original value of your holding for tax purposes. With this value, you can then calculate your capital gain or loss by subtracting your cost basis from the returns of each taxable event, such as selling off your crypto or trading it for another token. So, if after your calculations you get a positive value, then you made a profit. If, on the other hand, you obtain a negative value, then you've incurred a loss. The IRS does provide a way to offset your losses with your gains. So, if your capital losses outweigh your earnings, you can use up to $3,000 of your losses to offset your gains for tax purposes. As you might already be thinking on your own, this makes it important to regularly keep a spreadsheet or record of the date and price of every purchase you make. The next things to consider are the two factors that can affect your cost basis. We will now discuss both of these. The first of these factors is your accounting approach. The calculation of these losses and gains is to be done according to the options provided by the IRS. The IRS gives taxpayers the option to select the type of specific identification accounting they wish to use each year. These specific ID techniques match sales and acquisitions in various ways. So, applying the different variations to your trading data will result in different cost basis values. Three popular techniques have already been widely adopted. Number one is the first in, first out, or FIFO method, which assumes that you sold the securities that you purchased first. Number two is the last in, first out, or LIFO method, which assumes that you sold the securities that you purchased last. And number three is the highest in, first out method, or HIFO, which assumes that you sold the assets with the highest price first before others. The second factor that determines your cost basis is the transaction fees incurred during your purchases. Ethereum gas fees or transaction fees are frequently paid to exchanges or protocols as part of cryptocurrency transactions. These fees can frequently be added to the cost basis of your asset to reduce capital gains or raise capital losses. The next thing to consider when reporting crypto taxes is the tax rate that applies to your activities. Since long-term and short-term gains are taxed differently, you have to report them separately, and they should be calculated separately when reporting your capital gains. Short-term gains or losses occur within a year and are taxed at a range between 10 and 37%. In contrast, long-term capital gain or loss is applied after a year of holding cryptocurrency before selling it, and it is taxed at a range between 0 and 20%. Now that you have done the necessary calculations and have all transaction records ready, it is time to fill out IRS Form 8949. Before we continue, if you've enjoyed learning about these topics so far and would like to support our work, please consider subscribing to our channel. Your support helps us continue to create engaging and informative content, and we appreciate every subscriber who helps promote our hard work. Okay, where was I? Oh yeah, let's talk about the form with which you will execute your tax reporting. You can list your gains and losses from all of your crypto transactions during the year on this form, which you can either fill out manually or with tax preparation software. You can also record your total capital gains and losses from all sources on 1040 Schedule D, together with your short and long-term gains from Form 8949 and your cryptocurrency activities. As you fill out the forms, keep in mind that it is crucial to include any capital losses you may have suffered on cryptocurrencies throughout the tax year. In fact, reporting these capital losses also has its advantages as you get the benefit of the tax loss harvesting strategy. With that said, let's check out how you can reduce your crypto tax liability. While there are no legal ways to completely avoid paying crypto tax, you can only try your best to reduce the amount of tax you have to pay. And the easiest way to do this is to opt for the long-term plan. This is because the tax rates applied to long-term capital gains or losses are much less than what you get with the short-term variant. And on just one parting note, some people may find cryptocurrency taxes to be straightforward, while others may find them to be difficult or perplexing. It all depends on your type of transactions and how actively you trade or use crypto. Cryptocurrency taxes generally become more complicated the more active you are. So, if you're a business that operates using cryptocurrencies, you may need the input of a tax professional for your tax filings. As we end this video, if you're interested in starting to trade crypto but don't know where to begin, or you just want some helpful tips, be sure to check out our free crypto trading guide for beginners on cryptobookworm.com. You'll also find our weekly newsletter and some helpful tools there. Thanks for watching, and we hope to see you in our next video. Until next time, happy tax reporting.